Most Americans keep everything in one place. Saudi families have never made that mistake. Not because they distrust banks personally. Not because they know something criminal about the institutions holding ordinary American savings. Because concentration in any single institution is structurally incompatible with generational wealth preservation. And history has proven that point repeatedly. In 2008, Americans who had everything inside the banking system watched retirement accounts built over decades lose 40% of their value in a single year. People who had worked 30 years and done everything correctly, saved consistently, contributed without fail, trusted the institution completely, and watched it all move together, downward, because everything was connected to the same system experiencing the same stress at the same moment. Saudi families watched 2008 from a different position entirely. Not because they predicted the specific event. Because they had never concentrated their wealth in a way that made any single event capable of reaching all of it simultaneously. That is not luck. That is architecture. The 2008 financial crisis did not surprise Saudi families. They had already moved their wealth somewhere the crisis could not reach. Concentration is not safety. Saudi families learned this from history. Americans are still learning it from experience. If this channel is showing you something you have not found anywhere else, subscribe. There is significantly more coming. Understanding why Saudi families distribute wealth across multiple structures requires understanding what a bank actually is. Not what it feels like. What it actually is. A bank is a business. Every business serves its own interests first. That is not a criticism. It is a structural reality that most Americans were never encouraged to think about clearly. When money gets deposited into a bank account, it does not sit in a vault with a name on it waiting to be retrieved. It becomes a loan to the bank. The bank takes that deposit and lends it out at a higher interest rate than it pays the depositor. The difference between those two rates is the bank's profit. The depositor receives below inflation interest. The bank uses the deposited funds to generate returns that dwarf what it pays back. That arrangement is not hidden. It is simply something most Americans were never encouraged to examine closely. FDIC insurance exists. It protects deposits up to $250,000 per account per institution in the event of a bank failure. That protection is real within its limits. But understand precisely what it does not protect against. It does not protect against a bank restricting withdrawals during a liquidity crisis. It does not protect against decades of below-inflation interest rates quietly eroding purchasing power year after year. It does not protect against a bank-managed retirement account losing 40% of its value in a market collapse. It does not protect against fees charged across 30 years of account management that compound into a significant portion of accumulated savings. FDIC insurance is a ceiling on catastrophic loss in a specific scenario. It is not a guarantee of wealth preservation across a lifetime. Saudi families understand the distinction between those two things. Most Americans were never shown it clearly enough to act on it. In 2008, 25 American banks failed. Washington Mutual, the largest bank failure in American history at that point, held $207 billion in assets when it collapsed. Customers with deposits above the insurance limit lost the unprotected portion entirely. Customers with bank-managed retirement accounts lost alongside every other participant in the same institutional system experiencing the same simultaneous stress. The crisis did not affect all wealth equally. It affected concentrated wealth most severely. People who owned rental properties still received rent in October 2008. People who owned energy royalty instruments still received quarterly distributions. People who had separated their wealth across hard assets, structured vehicles, and income-producing ownership watched the crisis from a distance. People who had everything concentrated in one place experienced it completely. That difference between watching a crisis and being inside it is what the three-place system is designed to create permanently. Not as a crisis response. As a permanent structure built before any crisis arrives. There are three specific places Saudi families keep wealth instead of concentrated bank deposits. Three places built around one principle. No single institution's survival determines whether the wealth remains intact. Each place serves a different function. Each protects against a different category of institutional risk. Together they create a structure where no single event, no matter how severe, can reach everything simultaneously. The foundation of the Saudi wealth storage system is physical. Gold held personally. Land owned outright. tangible assets that exist completely independently of any institution's fate. This is not a new idea. It is the oldest wealth storage system in human history. And it works for a reason that has never changed across any century or any crisis. Physical assets held outside the banking system cannot be frozen. They cannot be subject to institutional bail-ins. They cannot lose value because a bank made poor lending decisions somewhere else. They cannot be inflated away by a central bank's policy decisions made on a Tuesday morning. They simply exist. Now understand a distinction that matters more than most Americans realize. There is a structural difference between assets held inside the banking system and assets held entirely outside it. A gold coin sitting in a personal safe at home is not the same as gold sitting in a bank safe deposit box. The coin in the personal safe exists outside every institutional risk entirely. The gold in the bank safe deposit box is stored inside a building owned by an institution subject to regulatory action, legal seizure, and operational disruption during exactly the kinds of crises when access to that gold matters most. During the Great Depression, the United States government issued an executive order requiring Americans to surrender their gold holdings to the Federal Reserve. Americans who had gold inside the banking system had no practical means of resistance. The asset was inside the institutional system that was making the demand. Americans who held gold entirely outside that system had options that others did not. That history is not ancient. It is instructive. Saudi families have held physical gold and land as the foundation layer of their wealth storage system across generations precisely because this layer requires no institution to function. No bank needs to remain solvent. No government program needs to continue operating. No market needs to remain liquid. The asset exists. The wealth is intact. Land compounds this principle further. Land owned outright, with no mortgage, no lien, no institutional claim attached, is perhaps the most structurally independent form of wealth storage available. It cannot be printed. It cannot be diluted. It requires no counterparty promise to maintain its value. A family that owns land outright during a banking crisis owns something real regardless of what every financial institution on earth decides simultaneously. A family that owns a mortgage home during that same crisis owns a leveraged position in real estate with a bank holding a legal claim on the underlying asset. Those two situations are not the same. American financial culture spent decades treating them as equivalent. The banking system profits from the belief that deposits inside institutional structures are safe. Saudi dynasties built their foundations on a different understanding entirely. Safe means requiring no institution at all. Anything stored inside a bank building is subject to that bank's institutional fate. That is the first place. The layer underneath everything else. The one that functions regardless of what the rest of the system does. The second place Saudi families store wealth is inside formal structures specifically designed to separate wealth from the operational risks of any single institution. Family offices. Private wealth governance frameworks. Structured vehicles that manage investment, distribution, and generational transfer of wealth independently of retail banking relationships. Most Americans hear the term family office and assume it is relevant only to billionaires. That assumption is the direct result of a financial culture that never had an incentive to explain the underlying principle to ordinary savers. The principle is straightforward. Operating money belongs in one place. Investment wealth belongs in another. Assets designated for generational transfer belong in a third. Those three categories of wealth serve different purposes. They face different risks. They require different structures to protect them effectively. A family that keeps all three inside a single retail bank account has created zero structural separation. When the institution holding that account experiences stress, all three categories experience that stress simultaneously. The grocery money and the retirement savings and the inheritance designated for the next generation are all equally exposed to the same institutional risk at the same moment. Saudi families have understood the importance of this separation for generations. A multi-trillion-dollar intergenerational wealth transfer is currently underway in Saudi Arabia. It is moving through family offices and structured wealth vehicles with formal governance frameworks and defined investment mandates. Not through retail bank accounts. The separation is deliberate. The structure is considered as important as the assets it holds. Because a family that accumulates significant wealth and then loses a substantial portion of it to institutional failure during a single generational transition did not actually preserve wealth. They preserved it until the structure they trusted failed them. The family office model at its core is not complicated. It is the practice of treating wealth management as a separate function from day-to-day banking. Creating defined structures with clear rules about what gets invested, what gets distributed, and what gets preserved for transfer. Separating the money that gets spent from the money that gets preserved from the money that gets passed forward. That separation does not require extraordinary resources to implement at its principal level. It requires the decision to stop treating all wealth as a single undifferentiated pool inside a single institutional relationship. American families who keep everything in one bank account have never formally made that distinction. The bank account holds the grocery money and the retirement savings and the eventual inheritance all inside the same institutional relationship with the same institutional risk attached to all of it. Saudi families sealed those categories from each other long ago. Not because it required a formal office with professional staff and billions under management. Because it required the recognition that different wealth serves different purposes and those purposes are not protected by the same structure. That recognition is available at any wealth level. The principle does not scale down. It simply applies differently at different levels. But the core decision, to separate operating wealth from preserved wealth from transferred wealth, is one any family can make. Most American families were never told to make it. The institution holding all three categories in one account had no financial incentive to suggest they be separated. The third place Saudi families store wealth is the one most directly opposed to what the American financial advisory system recommended to ordinary savers for 50 years. Income-producing assets that function entirely independently of banking system conditions. Rental real estate that generates monthly income regardless of what financial markets are doing. Energy royalty instruments that pay quarterly distributions from physical production regardless of market sentiment. Business ownership that generates cash flow from actual economic activity regardless of what banks decide on any given day. These assets share one critical characteristic. Their income does not depend on an institution's financial health. It depends on physical reality. A tenant pays rent because they need a place to live. An oil well produces because the physical resource is there and the infrastructure to extract it exists. A business generates revenue because customers need what it provides. None of those income streams require a bank to remain solvent. None of them require a market to maintain confidence. None of them stopped functioning in 2008. Now understand what the American financial advisory system offered ordinary savers as the primary alternative. Bank savings accounts paying below inflation interest rates on deposits the bank used for its own lending operations. Bank-managed retirement accounts invested in paper assets that move with the same institutional system experiencing the same simultaneous stress during any crisis. Certificates of deposit that lock purchasing power into fixed returns denominated in a currency losing value every year. Every one of those products exists inside the banking system. Every one of them performs according to the banking system's health. When the system is healthy, they function adequately. When the system is stressed, they fail alongside it. The people who owned rental properties in 2008 received rent in October of that year. The people who owned energy royalty instruments received their quarterly distributions while markets were collapsing around them. The people who had structured their wealth around income-producing assets outside the banking system watched the crisis from a position of ongoing income. The people who had everything in bank-managed accounts experienced the full force of what institutional concentration produces during systemic stress. Why did the financial advisory system consistently route ordinary Americans toward bank-managed accounts rather than income-producing assets outside the banking system? The answer has not changed. Income-producing assets held directly generate income for the owner. They require no ongoing management from an institution. They generate no ongoing fees for an advisor. Bank-managed accounts generate fee revenue for the institution managing them every single year regardless of performance. An advisor who helps a client acquire rental property or energy royalty positions has created a client with a self-sustaining income structure that requires no further advisory relationship. An advisor who keeps a client inside a managed account structure has created a revenue relationship with no natural endpoint. The system directed ordinary Americans toward the structure that served the system's revenue. Income-producing assets outside the banking system were available the entire time. The direction toward them simply never came from the people who were paid to give direction. 3 places. One principle connecting all of them. None depend on a single institution's survival for the wealth to remain intact. Physical hard assets held outside the banking system entirely. Structured wealth vehicles that separate operating money from investment wealth from generational transfer assets. Income-producing ownership that generates cash flow from physical reality rather than institutional promises. Saudi families have distributed wealth across these three categories for generations. Not as a response to any specific crisis. As a permanent structural approach built on one understanding. Any single institution, no matter how large, no matter how established, no matter how many government guarantees surround it, can fail. History has demonstrated that point more than once. American savers were encouraged to ignore that history and trust the institution. The institution benefited from that trust. The savers bore the consequences when that trust was tested by events the institution was not designed to withstand. The three-place system does not require extraordinary wealth to understand. It does not require dynastic resources to apply at its principal level. It requires the decision to stop organizing wealth the way a system designed around its own revenue instructed ordinary Americans to. Concentration is not safety. It never was. A bank is a business. Every business serves its own interests first. Saudi families understood this before most Americans were born. The families that understood it built structures that functioned through every crisis of the last 100 years. The families that did not are still learning the lesson. If this video gave you something your financial advisor never did, subscribe. There is more where this came from.